Today, I'm Abha Bakaya. With me, our global business editor, Udayan Mukherjee. First, a look at the headlines. Market ends lower amid volatility. Sensex down for a second straight day. Power stocks gain, banks underperform. Nestlé India Q4 misses street estimates on a one-time loss. Profit falls 20%, revenue up 9%. Board recommends dividend of 65 rupees per equity share. IT department conducts searches at former NSE MD Chitra Ramakrishna's residence. Ramakrishna is being investigated for allegedly making illegal financial gains by sharing internal confidential information of NSE to a faceless yogi. Supreme Court sets aside High Court order staying 75% quota for Haryana locals in private jobs, asks the High Court to decide within 4 weeks. Top Court also restrained the state government from taking any action against employers under the law during this time. Another day, another choppy session of trade. Second straight day of losses for the market. Sensex dropped over 104 points, tumbling to 57,892. Nifty ending flat, slipping to 17,304. Investors remain cautious after Fed minutes showed policymakers are in favor of faster rate hikes. Bank stocks led the drag today. Nifty Bank declined over 500 points. Top laggards, ICICI Bank, Axis, IndusInd, and in other stocks, Ultratech Cement and UPL. On the gainers list, we had Tata Consumer, HDFC, ONGC, Reliance, and HDFC Life. And it's absolutely great to have our global business editor, Udayan Mukherjee, with us, with me right here in the studio. Udayan, it's good to have you in the city. And markets at a time like this have been a huge question mark. We've seen immense volatility. First, this massive sell-off, and then the biggest one-day bounce we've seen in 10 years. What do you feel is happening? How much of it was to do with Ukraine? Is that behind us, or is the Fed a bigger threat?
Nice to be in the studio with you, Ava, for a change. It's very nice to be in Delhi after a long time. But I haven't seen volatility like this in a long time. You know, 500 down on the Nifty and then 500 up the next day. It's insane volatility. And I think it's reflecting the kind of mood in the markets globally and locally at this point in time. People are very unsure of how this story will play out. Because it's not just Ukraine. Ukraine is causing a lot of flutter at the market and deservedly. And I think it will also feed into the price of crude, which will nudge $100 very soon, and that matters a lot for India at a time when inflation is already quite high. So I think that is part of the problem. The bigger part of the problem is that we are having something which is happening once in a decade or once in many decades, which is after many, many years of very easy money globally, we are having interest rate hikes. And things are actually accelerating on that front. Earlier, we thought that it would happen later in the year. Now, not only has the time been brought forward, people are talking about 2 hikes together. Some are even saying 3 hikes together. And, you know, so locally inflation is a problem, crude is a problem, geopolitics is an issue, and the US Fed is the biggest issue of all. So all of it put together has led to some incessant selling from the FIIs, which has shown up in big marquee stocks like HDFC Bank and HDFC and all of those names. So I think we are in a lot of flux at this point, and probably this volatility will continue. And I don't have the heart to say that we've seen the worst of the correction. It's possible that the market eventually trends lower after this bout of volatility is done.
So that was my next question, and I'm going to remind our viewers that we will have the Ask Udayan segment starting again this Wednesday, now that all the budget and post-budget hecticness has abated. But Udayan will take those stock-specific queries, but the larger question from investors will, of course, continue to be, should they invest even at dips? Those that have become used to making a lot of money in this market may be in for a disappointment. Should they be booking profits? Should they remain invested? That's, of course, the most natural question from a retail investor.
You know, I think I will say 2 things, Abha. One is that this is the first proper correction in 2 years. I mean, after that big COVID fall in March 2020, we haven't seen a fall of this magnitude and this volatility. So in a sense, this is the first test for those young people who opened accounts over the last 2-3 years. They've never experienced something like this. So I think they will be tested. How much they will be tested depends on how deep this correction turns out to be. If it is 16,000 Nifty, 16,500 Nifty and no further, I think they'll probably ride it out because that's a 10% correction and that's not very deep. If 16,000 gives way and we head to 15,000 and lower on the Nifty, I think a lot of stocks will fall 25%. And that's going to be a big challenge for a lot of these new investors. So this is an acid test of whether of the maturity of these new investors and whether they can take such big falls in their stride. What should they do now to answer your question? I think anybody who's trying to deploy fresh money into the market should not do it in one shot at a time like this. Because no matter what analysts tell you, we cannot know for sure that 16,500 is the floor for the market. You know, it's an opinion. It may be right, but it's still only an opinion. My sense is that the best course of action at this point is to say, if I have 100 rupees of fresh money to invest, you probably stagger it over the next 3 months. Buy some now on the very bad days, and when the market falls again, buy some more. If you're already invested, what should you do is a more tricky question to answer, because it seems easy to suggest that you sell now and buy later, but that never is done so easily in real life. So I think for those people who already own stocks, maybe you clean your portfolio a little bit. Take out some of the higher beta names, some of the commodity stocks, etc., because they'll probably fall a lot more than some of the more stable names. But for fresh money, I would say patient, don't buy it in one shot, do it over 2 to 3 months, because this volatility will last some time.
It's going to be here for a while.
Some time at least.
Have to ask you on those tech stocks as well, because some of the volatility has been in some of these new age assets, whether it be tech stocks. Crypto is a whole different discussion. But you know, even that warrants a question. Perhaps if we have time, we'll take it. On the tech stocks, you know, we were waiting to see this come, and we're seeing the volatility. But is it too early to write them off? You know, what's really the verdict? And then we also have, of course, this mega IPO that's coming, LIC. And it's really starting to make everyone wonder whether it's going to suck out a lot of liquidity from the market and also add to the existing volatility.
No, you know, LIC is a bigger discussion for another day, so we should keep it for another discussion. But for the Zomatos and Nykas of the world and the Paytms of the world, I think this was inevitable. At some point, this had to happen because those valuations were just not sustainable. They were based on nothing. Now that many of these stocks have halved, it's a more interesting question. Do you get in here because you're not buying at the IPO price or 100% more than the IPO price? You're buying at, in most cases, 60-70% of the IPO price. Better entry point. The difficulty is that the kind of business models many of these companies have, not all, it's difficult to sustain IPO price. It's difficult to sustain or explain even half X of the IPO price, because they're not based on cash flows and real things. They're based on promises. So in some cases, and I would probably make the only exception of Nykaa. Nykaa is a company which actually makes profits, has cash flows, and it's not a pie in the sky like Paytm. So if Nykaa comes to a discount, a significant discount to its issue price, I would say it makes an interesting proposition. Paytm you just can't value. I mean, at 1,200 it was expensive, at 800 it looks expensive, at 700, who knows? It's a leap of faith. So I would say that if you really think the franchise is great, like some people believe Zomato is a great franchise, then you can start nibbling at these kind of levels because prices come off quite a bit. Better still to look at something like a Nykaa. But otherwise, I would say that most of these companies who have hit the market, these digital companies, I still think if the market volatility extends, you may find them even 20% cheaper from where they are today, despite the amount that they have fallen. So it's still a difficult call because of the lack of supporting cash flows.
All right. Well, we all have a lot of questions for then, you know, on some of these individual companies, on the upcoming LIC IPO, on some of the other big moves in the market. So do send us your queries. We'll take them every Wednesday.
And keep wearing the jacket. We need that color back on the screen.
All right, I promise to do that. Udayan, thanks so much for joining us, and we look forward to seeing you. Former NSE MD Chitra Ramakrishna is now under the IT lens. As per sources, the Income Tax Department raided Chitra's premises in Mumbai and Chennai. The search comes after Ramakrishna was penalized by market regulator Securities and Exchange Board of India for passing sensitive information to a yogi residing in the Himalayas. We have Munish Pandey joining us on this now. Munish, what are the allegations and why these searches by the IT department? What details are we picking up?
The IT officials have conducted searches at premises linked to NSE's former managing director and CEO, Chitra Ramakrishna, and Group Operating Officer, Anand Subramaniam, in connection with alleged financial irregularities and tax evasion. Now, as far as Chitra Ramakrishna is concerned, IT sources have told us that she is under probe for allegedly making illegal financial gains by sharing internal confidential information about NSE, which included financial details, details about organizational structure, and issues related to human resource department. This sharing of confidential information allegedly took place between 2014 to 2016. And what is interesting here is to note that CB even imposed a fine of ₹3 crore on Chitra Ramakrishna over irregularities during appointment of Anand Subramaniam. Now, as far as Chitra Ramakrishna and Anand Subramaniam is concerned, she appointed Anand Subramaniam as Group Operating Officer and advisor to her in 2015. And when she was under probe, in a bizarre clarification, she had then told the officials that she was being guided and advised by a yogi who lives in Himalaya. And now the IT officials want to know more about these irregularities during appointment of Anand Subramaniam.
Thanks, Manish. And we'll stay on top of that story for you. After the gloom and doom of the pandemic, the salaried class may have something to rejoice about. As per an Aon survey, India Inc. is likely to give out a 9.9% salary hike in 2022. Salary increments may touch a 5-year high as organizations are planning to invest in new age capabilities to build a resilient workforce amid strong economic recovery. Jung Bahadur Singh, Senior Consultant, Aon, joining us now. Mr. Singh, welcome to Business Today TV. After the dismal hike we've seen in the past 2 years, are we looking at a brighter future for salaried employees?
I think all indicators are there in terms of business sentiment being very, very positive. The industry results that have been coming out over the past 2 months have seen both an increase in top line and also improvement in bottom line. So absolutely, I think even from a salary increase perspective, we are looking at overall increase of 9.9%, which is actually going to be the highest since 2016. In fact, this is a 6-year period, the highest increase in 6 years. So from an employee standpoint, absolutely, this is going to be one of the highest salary increases in recent memory.
What exactly is fueling this hike in salaries that we're likely to see?
Led to this is one, the threat of the pandemic has subsided, or you can say the business has learned to live with the pandemic. There's inbuilt resilience that has given confidence. The other piece is the impact of the services sector. So if you look at what's happening, whether be it in IT, whether be it ITES, whether be it professional services, we are seeing massive growth come in, especially on the account of the fact that India is the leading outsourcers of technical and technology related skills. And these are the sectors which are really driving up the 9.9% number, wherein in some of these sectors, we're actually expecting double-digit increases. Which means that from an overall India perspective, the services sector is really booming, and which is really leading us to this number of 9.9% overall.
All right, Mr. Singh, thanks so much for joining us and taking us through the latest from that survey. And here's what else is making news in the corporate world. The country's largest non-tobacco FMCG player, Hindustan Unilever, continuing with its price hike spree. The Mumbai-based company that had hiked prices of its market-leading soaps and detergents in January has increased prices again. Brands like Lux, Rexona, Pond's, Surf Excel have increased prices of soaps, detergents and dishwashing products by 3 to 10% this month. Amazon will accept Visa credit cards across all of its sites as the two businesses have reached a global agreement. Amazon had last year threatened to stop the use of Visa credit cards in the UK due to fees Visa charged to process payments. However, Amazon and Visa said they've now struck a deal. A day after nationwide raids on Chinese tech giant Huawei, the company has told Chinese state media it will fully cooperate with Indian income tax authorities. In a statement, Huawei said it's confident the firm's operations in India are firmly compliant with all laws and regulations. FMCG major Nestlé declared Q4 results today. The company's profit fell by 20% year-on-year to 387 crore rupees. The board of directors of the company recommended a final dividend for the year 2021 of 65 rupees per equity share. The record date for the purpose will be April 8th. It will be paid on and from April 26th. Let's take a very quick break, and remember, we're back with our flagship query show, Ask Udayan. To get your stock queries answered every Wednesday, send us your questions on the number on your screen.
You are watching India Today.
In a bid to kickstart a virtuous cycle of investment, the Union Budget has sought to step up public investment by raising capital expenditure by 35.4%. But will high capex spend have the desired impact on recovery and growth? I sat down earlier with K.K. Mistry, Vice Chairman and CEO HDFC Limited, about the state of the Indian economy and how long before the recovery really picks up pace. Listen in. With the recent announcements of huge capex spends planned by the government, do you anticipate that this will have the desired impact on recovery and growth?
I would certainly think so. I mentioned in a few programs prior to the budget that in my view, the focus on the budget should really be on growth, because growth will lead to an opening up of the economy, it will lead to more jobs getting created, and it will lead to generally more income in the hands of people. And ultimately, it will kickstart economic growth, because jobs will result in, growth will result, or capex will result in more manufacturing, it will result in more spending on infrastructure, it will result in more jobs getting created. And as jobs get created, people will have income, they will spend that money. As demand increases in the economy, manufacturers, producers of services will have to provide more services, produce more, which means more people get employed. So it's basically a multiplier effect that sets in. So I think it is absolutely the right thing to do, because it will kickstart everything else in the economy.
Mr. Mistry, what's the kind of gestation period you see before all of this kicks in and we start to see results? A couple of quarters down the line, is that what you're anticipating? And which parts of industry, which sectors stand to benefit?
I mean, I would say during the course of the year. Now, whether it is going to be in Q1 or Q2 or Q3, that really depends on what the actual government program is in terms of how the expenditure is going to take place. But the fact that the government will spend so much money will mean that private sector will also step in its own way and start spending money, start, creating, building capex, spending money on capital expenditure, buying goods, buying fixed assets and stuff like that. So it will create an all-round effect with both government funding and private sector funding coming in. And one of the things that everyone has been talking of for a very long time now is that private sector capex cycle in India has been slow. And I think the best way to ignite that, the best way to get that going is for the government to also start spending money, where automatically private sector will spend along with it.
Do you see the recovery as continuing to be uneven? There has been a lot of criticism, of course, that it's a K-shaped recovery. And given the focus on infra, on some of those pockets of the economy, will we continue to see an uneven recovery?
No, I think it will be broad-based across the board, but it's not going to be that everything is going to start from day one. To my mind, the bigger focus to start will be on infrastructure, because infrastructure and housing is what creates a lot of jobs. On housing, I thought, if I recall right, 48,000 crores was allocated, and for infrastructure, it'd probably be a lot more, building roads and things like that. So that will be the starting point, but that will, as I said earlier, lead to more jobs. And if jobs get created, demand increases in the economy, then it will kickstart all other sectors in the economy.
Would you have liked to see more incentives for housing, Mr. Mistry?
It is always a job of industry to ask for things, and it is for the government to decide what to give and what not to give. But I truly believe that a lot has been done for the housing sector. We've created that buzz, we created that impetus which was required for housing to take off. And we were in that 2017 to 2019 period. I would say 2017 to almost mid to end of 2020, we were seeing the demand really coming in only from tier 2 and tier 3 towns and not really from the metros. Now what has changed in the last year and a half or so is that the demand, apart from coming from tier 2, tier 3 towns, is also coming equally strong or even more stronger from the metros.
Even as the government bears its intent to step up investment, the question everyone is asking is, when will private investment rise? Is the environment conducive enough for this investment, and are profit cycles encouraging enough? To answer these questions, Vishesh Chandyok, CEO Grant Thornton Bharat, and Suprakant Panda, MD IMFA, also Senior VP at FICCI, sat down with me for a chat. Listen in. Do you feel there are still significant challenges for companies in order to scale? Because if we take a look at the more unorganized, informal sector, for example, and they've seen the brunt, of course, of successive moves, whether it be GST, Demon, COVID, they have taken a lot longer to get back as opposed to some of the bigger companies and the kind of deal flow we're seeing there. Are you also observing an uneven recovery?
No question about it. I think, clearly, if you were in the informal sector, even before the pandemic, with the introduction of things like GST, you face challenges with demonetization, etc. So I don't think that has changed. I think clearly, if you want to operate in the supply chain, and you saw in the budget, the new norm, very much like you have on the direct tax side, the responsibility is with the company that is claiming the input tax credit to ensure that people in your supply chain have uploaded. Have paid their tax and uploaded the information. Otherwise, you're going to be denied the credit. So I think clearly you need to be in the formal ecosystem if you want to grow and progress along with India. You need to pay your taxes, contribute to that development. So that message is quite clear.
Shubhrakant, do you also feel a lot of what the government spoke about in terms of digitization, in terms of trying to create further formal processes, will also help in terms of increasing efficiency and creating better infrastructure, digital infrastructure for industry?
Oh, absolutely. Clearly there has been a thread of digitalization running through the various aspects of the budget, be it the health sector, where they've talked about putting all service providers, etc., on a common platform. So there are multiple examples running through the budget in terms of where the government is trying to focus on technology and on digitalization, which I believe is the way forward. And see, clearly the economy has to formalize even more going ahead. And it is in that on that path, I should say, rather. If you look at the consistently high GST collections being above 1 lakh crores for I think 4 or 5 months in a row, and the January figures being the highest ever, if I'm not mistaken, all of that points to the fact that the economy is formalizing at a rapid pace, and that is the way to go. And equally, of course, there are revenue loopholes which have been effectively plugged, and that has led to the higher GST collections. But yes, I do agree that digitalization and a focus on technology is evident in many aspects of government, and I believe that is perhaps a result of the Prime Minister's vision as well of a new India. And you certainly can't envision new India without being a tech leader, right?
And that's all for today. As we wrap, let us remind you that we will be taking your questions on Ask Uday on the following Wednesday. Do share your queries with us on the number on your screen.
Queens is definitely, one of the most diverse places in New York City and probably the country, maybe the world,